Student loans can feel like a necessary step towards securing your future. However, the true cost of these loans goes far beyond the amount borrowed. In fact, understanding the full financial impact can make the difference between a smooth financial journey and years of struggle. Today, we're diving into how to truly understand the cost of student loans and what you need to consider before you borrow. When you first take out a student loan, the amount you borrow is straightforward. But the real cost starts adding up when you factor in interest rates, repayment terms, and the time it takes to pay off the loan. Student loans typically come with a fixed or variable interest rate, which is the extra percentage of your loan balance that you'll pay over time. This interest can double or even triple the total amount you'll end up repaying over the life of the loan. The most common types of loans are federal student loans, which offer more favorable terms, and private loans, which can have higher interest rates and less flexible repayment options. The interest on federal loans is usually fixed, while private loan rates can vary depending on your credit score and lender. Let's break down how interest works. If you have a $30,000 loan with an interest rate of 5%, your monthly payments might seem manageable at first. However, over the typical 10-year repayment period, you'll end up paying nearly $8,000 in interest alone. That's almost 30% more than the original loan amount. Now consider that interest is often compounded daily, which means you're charged interest on both the principal amount of the loan and the interest that's already been added. Over time, this can add up to a much larger balance than you initially expected, especially if you're not making payments while in school or during a deferment period. Another major factor to consider is the repayment term. Federal loans typically offer a standard 10-year repayment plan, but there are other options available, such as income-driven repayment plans that base your monthly payment on your income. While these plans can offer lower payments, they also extend the length of your loan, meaning you'll pay more in interest over time. For example, a 10-year loan might be manageable, but what happens when that loan stretches to 20 or 25 years? A 25-year term could lower your monthly payment significantly, but over the long term, you could end up paying double or even triple the amount you borrowed, all due to the extended term and accumulated interest. Let's not forget about the impact of interest on the total amount you owe if you defer or forbear payments during school or for emergencies. While you may not be making payments during these times, the interest continues to accumulate, often capitalizing, meaning you'll be paying interest on the interest. This can significantly increase the total amount you owe when you finally start making payments. For borrowers with large loan balances, even a small increase in interest can translate to tens of thousands of extra dollars over the life of the loan. And the financial burden doesn't end once your loan is paid off. The way student loans affect your credit score and ability to save for other financial goals like buying a home or saving for retirement is another aspect to consider. To fully understand the true cost of student loans, it's essential to consider the interest rates, loan terms, and long-term financial impact. It's not just about the monthly payment, it's about the total amount you'll pay over the life of the loan and how it will affect your financial future. When planning for student loans, always take the time to explore all your options, including repayment plans and the total interest you'll pay. This will help you make informed decisions and avoid unnecessary financial strain down the road. By understanding the full scope of your loan, you'll be better equipped to manage your finances and set yourself up for a more secure financial future.